Kraft Heinz says it is pausing its split, which was originally planned for September of this year. The $46 billion merger, masterminded by Warren Buffett, made Kraft Heinz one of the largest food companies in the world. However, the merger has not gone as planned, with the company now forecasting a weaker than expected 2026. To break this all down, we're joined by Arun Sundaram, Senior Vice President of Equity Research at CFRA. Arun, thank you very much for joining us.
Yeah, thanks for having me.
Initial reaction to the numbers, which ones stand out? Which ones cause for concern?
Yeah, no, it was a disappointing quarter to end a quite disappointing year for Kraft Heinz, but that's not a major surprise. This is a company that's been sort of struggling for really the past, I would say, like 5 or 6 years. It's been a challenging environment for Kraft Heinz. Even over the last 4 years, the company hasn't grown volume sales, and a lot of that has to do with the fact that a lot of these packaged food companies, Kraft Heinz included, have been raising prices over the last several years. But pricing is not given; it's earned. And I think a lot of these center store packaged food companies are learning that a lot of the price increases that they've taken over the last few years are somewhat unjustified. And so 2026 is likely going to be a big reinvestment year for Kraft Heinz. They're likely going to lower prices, invest more in marketing and R&D, things like that. And while that should yield better results, it's probably not going to come immediate. So 2026 is expected to be a big down year. But the goal right now is that 2027 should look a lot brighter. But that's a long ways out. So we'll see if that really happens.
And was there one side or the other that took a bigger hit in this, or is it just kind of all across the board?
Yeah, really, right now there's. I mean, a year ago it was really a lot of their legacy grocery brands were struggling. Think like Capri Sun, Jell-O, brands like that, Oscar Mayer. But now we're starting to see some weakness across more brands, even some of their historically faster growing brands. Like its condiments business used to be much faster growing. It still is, but there's a little bit of a deceleration there. And I think that's largely why the company decided to pause the planned split or spinoff. Mm-hmm. It's because they're seeing some weakness spread across more of their portfolio. It's not just their legacy grocery brands anymore. It's a bigger piece. And so now the plan is to really revive growth of the entire portfolio before they consider, another spinoff or something like that.
And I mean, the new CEO just came in for January 1st. It really didn't waste any time on this decision. It must say something.
Yeah, that was a little surprising because Steve, he came on January 1st. He actually came from Kellogg, which actually spun off into Kellanova. And so when Kraft Heinz announced that he was joining the company, everyone thought, oh, this is the person that will lead Kraft Heinz through the spinoff. He's done it before. He's here just for the planned separation. And then now it's just a little bit over a month and they've called it off. I think what's not a coincidence is that a few weeks ago, Berkshire Hathaway, their largest shareholder, put this filing in that they could potentially sell their entire stake of Kraft Heinz. And they own about, I think, like 28% of Kraft Heinz. So that probably added to some pressure here and maybe caused the company to, be like, hey, maybe we want to pull back or pause on this separation because they don't want to angry their largest shareholder because, it's a tough sell to investors when your largest shareholder exits the company and you're trying to tell all the other investors that, hey, we're planning to split into two separate companies. Believe in us when, obviously your largest shareholder, which is not just any shareholder, it's Berkshire Hathaway and Warren Buffett, and they're, making the run out the door.
So is Callahan, do you think, is he the one who can bring these two together, or is he just trying to clean it up and then set it up for another split again?
Yeah, that's the big question. Right now, the talk is, or the rationale is that it's just a pause. They're not canceling the spinoff. They're pausing it right now. The goal is to get back to profitable growth. That's not going to happen in 2026. Maybe 2027 they'll get back to profitable growth, and at that time maybe they'll reconsider a spinoff or a split. But that's a long ways out. A lot can happen between now and towards the end of 2027. So we'll see if they really do go forward with the split. Because, like I said, they probably do want to get the backing of their largest shareholder right now, which is Berkshire Hathaway, and they haven't been. Berkshire Hathaway hasn't been particularly pleased with the spin or the separation.
And I mean, it's quite the challenge too when you've got losses across the board. Where do you start?
Yeah, no, exactly. Like if you look at looking at the results right now, and they've been declining organic sales for the past few years. On top of that, they've been experiencing some significant margin pressure. Kraft Heinz actually used to historically have some of the strongest operating margins throughout the entire packaged food space, but that's been deteriorating over the last several years. So they haven't been able to grow sales. Their margins are coming down. Earnings have been coming down. The 2026 forecast was well below consensus expectations. And part of that is because they've announced this $600 million investment in 2026. So they're doing things like investing in lowering prices, increasing marketing expenses, increasing R&D, and all that will have a near-term impact to margins. You don't typically see those investments pay off immediately, so it takes a while, and that's why 2026 is expected to be a pretty sizable down year. We're now looking at to look at the dividend actually, because if you look at where their earnings are forecasted for 2026, their dividend payout ratio is around like 75 to 85%. That's quite high for a packaged food company. You typically want to be around 50 to 60%. So if this earnings weakness does linger into 2027, which we don't foresee right now, but if that does linger into 2027, then there's going to be bigger questions of whether this dividend will be cut. And it was cut in the past before too. In 2019, Kraft Heinz cut their dividend by over 30%, and they've really been struggling ever since that dividend cut in 2019.
Okay, some challenges ahead then, Arun. Thank you very much for joining us.
Thank you for having me.
Arun Sundaram is Senior Vice President of Equity Research at CRFA Research.